Most finance videos tell you where to invest your money. Today, I'm going to talk about something far more important where you probably shouldn't invest. There's a corner of the UK stock market that looks exciting with high growth companies and innovators, but in reality, it has quietly destroyed investor returns for years. It's called the Alternative Investment Market, or AIM. And here's why this matters to you. You might already be exposed to AIM without realizing it in your ISA or your pension fund, or might have heard AIM stocks are good for inheritance tax. I spent 7 years working in private credit here in London, analyzing companies and underwriting deals worth hundreds of millions. And one thing I learned is this: the riskiest businesses often look the most exciting from the outside. So in this video, I'll show you why AIM has struggled, when it can make sense to invest, and how to avoid the mistakes that cost retail investors money. Let's start with the basic. And this is actually the perfect moment to talk about AIM because AIM turns 30 in 2025. So it initially launched as a light touch flexible market designed to help small and fast-growing UK companies to raise capital more easily than on the main London Stock Exchange. So it started with just 10 companies worth a combined of £82 million. Now, throughout the years, it was home to some of the UK's most dynamic companies: Boohoo, ASOS, and yes,
Nothing beats a Jet2 holiday.
Jet2. All these companies use AIM as a launch pad during their early growth phase. AIM gave them access to funding they simply could not have found elsewhere at the time. And it's, over the 30 years history, AIM has helped more than 4,000 companies raise nearly £136 billion. So from an economic perspective, AIM has made a real contribution. Now, from an investor perspective, the picture is much more complicated. And, this is why if you're saving for retirement or building an ISA, understanding the track record of AIM is essential. Why you should care? Well, even if you never bought an AIM stock directly, it still matters to you for 3 reasons. Firstly, you might already own AIM stocks without knowing it. Some UK ISA and pensions fund include AIM holding inside their UK small cap or active UK equity strategies. AIM long-term performance has been extremely weak. If you see the chart of AIM all stocks for as long as I can have it, you can see a lot of volatility, ups and downs happening during the 2008 global financial crisis and then during COVID, but not real upward trend, really. Now, looking at the performance since 2020, the return of AIM All Stocks Index has been plus 3% in the last year, but minus 30% in the last 5 years. And that gap compounds massively over time. And that kind of instability makes it extremely difficult for ordinary investors to make money. AIM's tax advantages have also changed. So for years, AIM was popular mainly because certain AIM shares qualified for a tax advantage called business relief, meaning they could be exempt from inheritance tax after just 2 years of holding them. That made AIM attractive for estate planning, not because of companies, were strong investments, but because the tax benefit was valuable. So let me give you a quick example so you can see what this tax relief actually meant in practice. Imagine you had £20,000 invested in qualifying AIM shares and you held them for at least 2 years. So under the old rules, if you passed away, your family could avoid the 40% inheritance tax in the UK on that amount. 40% of 20,000 is 8,000. So in theory, using AIM to benefit from the business relief tax scheme could have saved your family £8,000 in taxes. That's why AIM became so popular with high net worth estates. But that landscape has changed. In the 2024 UK budget, the government cut this inheritance tax relief by half. So in the previous example, you're now only saving £4,000 in taxes and you have to pay the remaining £4,000 to HMRC. And there is growing concern that HMRC may scrap the relief entirely. If someone is suggesting AIM as a tax-efficient strategy, you need the full context. Now, what has gone wrong? Why has AIM, struggled? AIM is a bit like a neighborhood where, anyone can open a restaurant. You get a handful of amazing places, a lot of average ones, and few that looks like they should have been closed by the health and safety inspectors ages ago. As an investor, unless you're a professional food critic, it's extremely hard to know which is which. In simple terms, AIM struggles because its company are smaller, riskier, and less liquid. Those weaknesses show up directly in the long-term returns. So AIM grew fast and then shrank dramatically. AIM hit its peak in 2000 2000 with almost 1,700 listed companies. You can see this on this graph. But then since then, the trend has reversed sharply. As of 2025, just under 700 companies remain and 61 companies left AIM in the last year alone. That's not the sign of a healthy market. The other problem is that AIM no longer serves the high-growth firms it was built for. In private credit, we often reviewed UK tech companies and high-growth firms, and one thing stood out: none of them wanted to list on AIM. Why? They either stay private because venture capital or private equity provide more than enough funding, or list in the US where they can get high valuation and more liquidity. AIM simply just cannot compete. Company quality varies massively. AIM was intentionally designed with light touch regulation, which sounds great, but it also means lower quality control. Some AIM listed firms are fantastic, some are okay, honestly, in my previous job, I would not have lent to them, let alone bought their shares. Liquidity is also extremely poor. Even on a good day, AIM stocks have often 10 to 15% bid-offer spreads, when in the main market, you're talking about a fraction of a percent. And if you're not familiar with spreads, think of it like this. It's the same feeling you get in an airport currency exchange. One price to buy your British pound, and a much worse one if you try to sell them back immediately. That gap is the spread, and it's money you lose instantly. On AIM, that gap is huge, and poor liquidity matters because it means your money can get trapped. You can buy, but you can't easily get out. Quick pause. If you're finding this helpful, feel free to like and subscribe so more people can avoid those mistakes too. To really understand AIM's performance, let me show you a chart comparing the AIM 100, the top 100 companies part of AIM, with the FTSE 100, the UK's top 100 largest and most established companies. And the contrast is striking. You see here on this graph, the green line is AIM 100 and the blue line is the FTSE 100. This graph shows the relative performance of these two, taking the starting point in 2016, so 9 years ago. You can see that, whilst the FTSE 100 has gradually increased, the AIM 100 has had a completely crazy ride. So if you invest £100 in 2016 into both markets, today it would be worth £140 on the FTSE 100 and sadly only £92 on the AIM 100. So you would have lost 8%. And bear in mind, that's the best part of AIM, not the average company, the top 100 AIM companies. If even AIM's top performance struggle to keep up with the FTSE 100, which is the market, not exactly known for high growth, that tells you everything you need to know about AIM's risk-reward profile. And this matters for one simple reason: you don't need to take AIM's level risk to get UK equity exposure. So should you invest in AIM? Let's be honest, for most retail investors, especially beginners, the answer is probably no. To give you a sense of where AIM sits on the risk spectrum, here is a simple ladder. Government bonds are the lowest risk. FTSE 100, large, stable company, medium risk. And AIM is the highest risk. If your goal is long-term wealth, AIM sits at the very top risk ladder, and you should diversify it into safer layers first. So if it isn't the right place to start, what should you look at instead? For UK exposure, the FTSE 100 offers stability and dividends, so it's not a bad place to start. And if you want global innovation, things AIM was supposed to provide, a global small cap ETF or MSCI World Tracker usually gives you more growth with far less risk. And if you still want AIM exposure, here is the smart way. Don't stock pick alone. If you're using AIM stacks, use professional managers with specialist inheritance tax AIM portfolio. Keep AIM a tiny part of your portfolio. Prioritize global diversification first, because most UK investors are already overexposed in the UK. If you think about it, from your salary, the price of your house, or the company you work for, they all depends, on the UK economy. I would also check your existing funds. You might hold AIM stock without realizing it. At the end of the day, my goal isn't to scare anyone away from investing. It's to help you avoid unnecessary risk. So to wrap up, AIM turning 30 is a perfect moment to look back honestly. AIM is a market that has done a lot for the UK companies, but not nearly as much for UK investors. It's volatile, illiquid, expensive to trade, and packed with businesses that do not always survive. And with the tax advantages shrinking, the risk-reward balance simply doesn't stack up for most people. And if you remember one thing from this video, here it is. You don't need AIM level risk to build long-term wealth. There are safer, stronger, and more diversified ways to invest, and they compound far more reliably over time. If this video helped you avoid a mistake, then it's already done its job. So thank you for watching, and feel free to subscribe for more clear and practical investing videos. See you soon.